Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia. Our webinar today is titled Right in the Bull and Bear Market with Exchange Traded Fund. And my name is Choo. I'm the speaker for this session. Now, today, we're going to talk about how do you use conventional ETF to build a global portfolio and meet your investment objective, and how do we use leverage ETF to gain magnified exposure, and how do we use inverse ETF to hedge our stock portfolio. Before we begin, here is a disclaimer. Whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to briefly introduce myself. I don't want to blow my own horn. So basically, I've invested in the market since 2009, and I've traded stocks, ETF, and currency as well. The first time I bought an ETF was, I think, in 2015. And so these are my experience investing and trading in the ETF market, right? So I've also I've traded leverage and inverse ETF. And today I'm here to share with you some of my experience in making investment in ETF, as well as doing tactical trade with leverage and inverse ETF, right? And sometimes I'm engaged to speak for investment banks. Sometimes I'm engaged to speak for technical charting companies. And here I am to speak for Bursa Malaysia on right in the bull and bear market with exchange traded fund. All right. So today we have very short amount of time, which is about an hour, but there are a lot of content I want to cover. So I will make it brief and succinct, right? So number one, we're going to talk about overview of the ETF in Malaysia. Then we're going to learn how to evaluate the exchange traded funds. Then we're going to debunk the liquidity myth of the exchange traded funds. We're going to learn how to do tactical trades with leverage and inverse ETFs. And we're going to master the math compounding effect of leverage and inverse ETF. And last but not least, we're going to build a global portfolio across multiple asset classes with exchange traded funds. So without further ado, let's go. Now, this is our FBM KLCI over the past 10 years. So, but as you know, the FBM KLCI is the major index in the Bursa Malaysia, but we can't really buy into an index because as index track the constituent stocks is not an investment instrument. So if you want to invest in FBM KLCI because you think that now it is undervalued because it's trade below the historical mean, you want to buy ETF, do you want to do value investing, you want to buy into the index, what can you do? Of course, you can't buy into the index, but you can buy into an ETF that seeks to replicate the investment return from the index. So you can, the solution is to buy into an exchange traded funds that benchmark and that tracks the index. All right. So this is an example of an index and the index ETF, which is FBN KSI ETF. So if you take a look at this, you see the ETF mirrors the returns of the FBN KLCI. Of course, there are some tracking differences across 10 years period, but it typically mirrors the return by FBM KLCI, right? So you can't buy into an index, but you can seek to buy into a ETF that tracks the index. So what exactly is an ETF? Now, ETF stands for Exchange Traded Fund. So it's like a mutual fund that is traded on the stock exchange. So it tracks an index, commodity, bonds, or a basket of assets like an index fund. So each ETF invests in asset according to its investment objective. So before ETF was invented, people, if you want to get a diversified exposure, you can buy a unit trust, okay, or buy a mutual fund. But when you buy a mutual fund or unit trust, typically the first time you purchase, there's going to be an initial sales charge, which typically range from 5% to about 5.5%. Then, of course, every year you're going to pay an annual trustee fee, asset management fee, custodian fee, and administration fee, and so on. So if you invest 10,000 ringgit, maybe the first year effective investment is only 9,000 something, because there are some fee that is channeled towards paying the distributors of the funds or paying the fund manager. So the initial sales charge is typically up to 5.5%, and this will be shared between the intermediary distribution channels. All right. For example, unit trust consultant who serve you, or the licensed financial planner who serve you, who recommended the funds to you. So they will be shared between the fund house and the distribution channels, right? So this is going to be the case. But if when the investment amount grow bigger, then some people will think that this fee is becoming a pretty hefty, right? For example, if your investment amount is 10 million, then the fee that you pay to the agents will be quite substantial. So that's why there are professionals in Wall Street or in the US invented this ETF, okay, that seeks to mirror the performance of an index, okay? So it's like a mutual fund that's traded on an exchange. So what they do is they just typically do away with the middleman, okay? So you don't have to go through a middleman like the unit trust agent or unit trust consultant to buy a unit trust, but you can also achieve the same objective by buying into exchange traded funds, which is passively managed. All right. So if you buy the fund on the exchange, then you don't have to incur so high, like 5% of initial sales charge to pay the distributor of the fund. So you can save that amount of money by buying the ETF that is passively managed. So this is the characteristic of a mutual fund. Okay, they consist of a portfolio of assets. So when you buy into a fund, you instantly gain diversified exposure to different assets. They charge you a management fee, and it allows you to create and redeem units. So when you want to buy, they create the units to sell to you. And you want to sell, they redeem the units from you. So these are the characteristics of a mutual fund. How about shares? All right. So these are the characteristics of shares. Okay, they are publicly traded. They have a T+2 settlement. They trade through a brokerage account, and they charge low transaction costs, like typically 0.1% for cash account, for transaction costs and so on. And you use your stockbroking account just like how you buy shares. How you buy ETF is just like how you buy share. All right. So it's publicly traded. Because it's publicly traded, you don't have to go through an agent or unit trust consultant who sell the unit trust to you. So sharing the best of both worlds is actually the exchange traded fund. So that sits in between of these two circles, right? So this ETF shares the characteristics of both worlds. So when I talk about ETF, right, we have so many different asset classes. So every ETF has their own investment objectives. Just like when you buy unit trust, they have their own investment objective. So when you buy ETF, it is the same. You must understand the investment objective. And different ETF, they buy into different asset classes. Of course, majority of the ETF that we see in the market right now is based on equity. Okay, they buy shares, right? Of course, you also have ETF that tracks commodity prices, where ETF that tracks bond, and we have ETF, that is have synthetic replication using derivatives. So they use derivatives, futures, or swaps to meet their investment objective. All right. So these are what we call a geared fund or a leverage and inverse ETF. So here are the lists of the exchange traded funds that we have in Malaysia. So the color in green means that they are Sharia compliant. All right. So we have the Trade Plus Sharia Gold Tracker, which is under commodity asset class. We have if you want to buy into a FBM KLCI ETF, this is issued by M Funds Management. Okay, you can buy into FBM KLCI ETF. If you want to get exposure into ASEAN market, you can go to Principal ASEAN 40 Malaysia ETF, which is equity. You want to go to China, you can go to China 50 ETF or Trade Plus New China Tracker. Okay. If you want to get into Malaysia momentum stocks, okay, you can go to Trade Plus Malaysia Momentum Tracker, or you want to buy into Asian REITs, right? You can go to Trade Plus MSCI Asian ex Japan REITs. if you want to, so which give you exposure to properties, right? If you want to go to buy into Southeast Asia, you can consider this my ETF MSCI Southeast Asia Islamic Dividend Fund. You want to go to a US market, which are Sharia compliant. You want to buy into Sharia compliant stocks, the top 25 largest Sharia compliant stocks in America. You can consider this my ETF Dow Jones Islamic Market Malaysia Titans 25. If you want to buy to just US stock without any sorry, I make a mistake. Okay, if you want to buy into 50 largest Dow Jones US Dow 50 largest Sharia compliant companies in US, you should consider my ETF Dow Jones US Titans 50. For this, my ETF Dow Jones Islamic Market Malaysia Titans 25 is invest in the 25 largest um, Sharia compliant companies in Malaysia. All right, so I jump up the order. So for Malaysian Islamic ETF, yes, you can consider this. Also, these are issued by IVCAP. If you want to consider another China fund, there's one issued by Value Partners. So China A-Shares 100 ETF. Okay. So then you want to consider bond, there's ABF Malaysia Bond Index Fund issued by M Funds, and you want to consider leverage and inverse ETF. These two are issued by Genangan Investors. Okay, we have 2 times leverage ETF, and we have a one daily inverse one-time ETF. All right, so these are 16 ETF that are available in Bursa Malaysia. So what you need to know in ETF, first and foremost, the first thing you need to know is the investment objective. Like when you buy into unit trust, whether it is a growth fund, it's a balance fund, it's a dividend fund, a conservative fund, and so on, you must know the objective, right? So the unit trust agent will recommend the funds based on your needs, based on your requirements. So they recommend the fund. Similarly, when you want to buy and invest into an exchange traded fund, you must know what is the investment objective. Okay, what is the benchmark that they track, which index they track, and what would be the likely stocks or constituent stocks that are in the index. Okay, so you roughly would know what is the objective, right? Number 2, risk. You must know what would be the risk that could be involved. So number 1, market risk, right? If you buy into stocks that tracks the US index, then you must know that, what would be the market risk involved in the American market. If you buy into a ETF that tracks gold, then you must know what would be the factors that can cause the gold price to change. So this would be the market risk. Number 2, tracking difference. Okay, every fund managers in ETF will seek in their best ability to as closely as possible to track the index return. For example, if index go up 1% today, the ETF that tracks the index would want to perform like 1% return today, okay, or before fee expenses, okay. So usually 0.999%, all right. So they want to minimize the tracking difference as close as low as possible, okay. The index, the ETF that have a tracking difference that differ greatly from the index may not be so efficiently managed. Okay, so this is second risk that you must know. The third is currency risk. When you invest in the ETF, does it involve foreign currency? Because some ETF, they could, for example, just now we have seen ETF that tracks the US market. We have seen ETF that tracks the Chinese market. So if they are buying into Chinese equities or buying into the American equities, then they will involve currency risk. Okay, and some ETF they could be quoted in US dollar, so that also involve currency risk. All right, liquidity risk. Okay, liquidity risk is where when you want to buy the ETF, there may be insufficient liquidity in the market for you. So but in Malaysia, the requirement is that all the ETF issuer must appoint market makers to quote the bid and ask. So in Malaysia, the liquidity risk is fairly minimal, right? So the requirement is that the market maker, Bursa require the market maker to be there in the market at least 70% of the time. Okay. So we have suspension of creation and redemption risk. This is the next risk. In terms of cost, this is another consideration you must know before you invest in ETF. Number one is you must know that the passive funds always have a lower expense ratio. If a passive fund have a higher expense ratio than the active funds, then something will be wrong. Okay, ETF is passively managed. Okay, in other words, all right. In other words, if ETF return uh is not up to your standard, it is not the fund manager's fault, right? Because fund managers don't actively buy and sell stocks to deliver returns for you. The fund managers just mainly track the index. Okay, for instance, let's take FBM KLCI, right? FBM KLCI consists of 30 largest constituent stocks. If there's no changes to the constituent stocks and no changes to their weightage, the ETF will not have any changes in their portfolio. All right. So if the ETF performance do not meet your expectation, it's merely that the index return do not meet your expectation. Okay. But of course, if you buy into a unit trust, okay, if the unit trust is not performing, then you may question the fund manager, what have you been doing, right? So for ETF, it's mainly, right, when you pick the ETF, you must already know what index are they tracking, right? And you must know the index fairly well, because the index return will likely be the ETF return. All right. So the second cost that we need to pay is the brokerage fee. Okay, just like how you buy and sell shares, it incurs a brokerage fee when you buy and when you sell. The third cost that exists is the bid and ask spread. Okay, because there are market makers in the market who quote you the bid and the offer price, so you must the bid and offer, the spread is the cost that you pay in buying and selling the ETF. All right, so always make sure that the spread is as narrow as possible. So how do we evaluate an exchange traded fund? Number one, we look at the performance, okay, whether the ETF that tracks the index deliver a performance that meet your expectation or not, okay? So what are the historical performance like? Number two, expense ratio. You must know how much are they charging for their fund management fee, and all in, what is the expense ratio like, okay? Must always remember the passive fund, typically in Malaysia, the ETF expense ratio should be less than 1%, should be. Volatility, are they very volatile? Four, do they declare dividends? Okay, when you buy ETF, you should know already the investment objective. Is it a dividend ETF or is non-dividend ETF? Some ETF pay dividends annually, some ETF pays dividend quarterly or semi-annually. Fifth, issuer. Who is the issuer that issue the fund? Okay, so that's what you must know. Okay, so this is a common myth that people have, right? Aren't ETF liquid? Because I look at the ETF price, right? It is not that healthy, looks like not that healthy, or is a bit more ugly looking. Okay, there's not much volume. Okay, so just want to share with you is that volume doesn't equal to liquidity. Okay, just not enough volume you see in the market doesn't mean that there's no liquidity for you. Okay, just that the transaction volume is very low. But when a transaction volume is very low, it doesn't mean that there's no liquidity, because ETF require the Bursa require ETF to appoint market makers to quote the bid and ask for you. So the ETFs are always liquid. The market makers are there always 70% of the time. Okay, so their job is to provide liquidity in the market by putting up bid and ask prices at the current fair value of the ETF. Okay, that could be a 1 or 2 bit away from the fair value. All right, so this is the role of the market makers. So sometimes they put in the bid and ask price, but then if you don't transact, then on that day there's no volume. So when you look at the share price, you see no volume. Okay, but it doesn't mean that there's no liquidity. Okay, it's just that there's no transaction. All right, so when you buy and sell ETF, what is important is to focus on the buy queue and the sell queue. You must take a look at this too. Okay, the buy queue and the sell queue. Okay, so you don't focus on the traded volume. Is it sum of the traded volume, right? Is zero. Okay, zero, zero, zero. There's no transaction yet lah. There's no transaction yet. Okay, but it doesn't mean that there's no liquidity. Okay, so there's still liquidity in the market. So how do we know that if the current ETF price is fair? Okay, how do we know? Now, you can go to www.bursamarketplace.com. Just hover over to ETF. So this is a screenshot of Bursa Marketplace. So if you go to the ETF listing, you will see that IOPV. Okay, and this is the column IOPV. Okay, what exactly is IOPV? IOPV stands for Indicative Optimized Portfolio Value. In other words, this is real-time fair value of the ETF. Okay, if you reference the net asset value of the ETF on their issuer website, they often update by the end of the day. ETF update their listing and the holding usually at the end of the day. So then you can only get end of the day data. If you want to get real-time data, you can come to Bursa Marketplace to find the IOPV to let you know what is the real-time fair value of the ETF. But be mindful that this IOPV is actually delayed 15 minutes. Okay, so it is not exactly that real time, but it has a delay of 15 minutes. All right. So this is a IOPV. Now you notice that some of the IOPV is zero. It doesn't mean that the fair value is zero. It just means that the pricing is not transparent, that it cannot reflect the real time fair value. For example, the my ETF Dow Jones US Titan 50, because it tracks the US market. By the time Bursa Malaysia is open, US market is closed. And because US market is closed, so there's no real-time portfolio value for you. So how do you know the fair value of this ETF? You go to the issuer website. This is issued by IVCAP. Just check what is the current net NAV, net asset value. All right. So I've briefly talked about the conventional ETF. So let's talk about how do we do tactical trades with leverage and inverse ETFs. So leverage ETFs seek to return a multiple of the one-day return of the index or other index before fees and expenses. It is for traders who want to pursue magnified returns or get a target level of exposure using less cash. All right. So for instance, if the index return one time, for example, 1% return, the 2 times leverage ETF will deliver 2% return. Okay. Similarly, if the index deliver negative 1% return on a daily basis on that day, then the 2 times leverage ETF will deliver negative 2% return for that day. Okay, so the keyword here is multiple of one-day return. Okay, so multiple of one-day return. Okay, the 1 day is very important. All right. In I think the regulation by the Securities Commission for now only allowed issuers to issue 2 times leverage ETF. So the 3 times leverage ETF is not yet available in Malaysia. But of course, you can find 3 times ETF elsewhere in other parts of the world, right? In Bursa Malaysia, 2 times leverage ETF is what we can find. So if you want to pursue magnified returns, if you want to get target level of exposure using less cash, leverage ETF is one instruments that you can consider. So this is an example of the 2 times leverage ETF that is issued by Kenanga investors. So if you take a look at the return by the FBM KLCI, okay, and then of course over the past year or so, FBM KLCI went down by negative 5%. So if FBM KLCI went down by a bit, then of course the 2 times leverage ETF will went down a lot more. All right. So So you can see that leverage 2x ETF mirrors the performance of the index that it seeks to track. Now, if you have just taken note that the FBMKSCI was trending down for the past year, so if you want to profit from a market downturn in a bear market, right? How do you make money in a bear market, right? So what you can do, you can actually consider to invest into inverse ETF, right? You can buy inverse ETF, okay? Not short, you can buy inverse ETF. Now, in Bursa Malaysia, regular investors cannot do RSS, okay, but you can do IDSS, intraday short selling. So the short selling function would be limited to certain stocks, but if you want to gain inverse exposure to the benchmark index, then you can consider to buy into inverse ETF. All right. So a broad market weakness, you buy into inverse ETF. So inverse ETF seek to return an inverse multiple of the one-day return of an index or other benchmark before fees and expenses. It is for traders who want to profit from a market decline. You want to hedge against a market decline. For example, you have a stock portfolio. Okay, you have let's say you have 90% of exposure into the equity market. You have 10% cash balance in your portfolio. Okay, you're 90% invested, 10% cash. All right, but the index is coming down due to weakness from the broad market or from negative sentiment from the US or Hong Kong or China market, because it caused the index to come down. And because the index comes down, your portfolio take a hit, right? But you don't want to sell your portfolio because you don't really want to let go of the stocks. You want to collect the dividends. So what you can do to protect your portfolio, you can buy using the balance 10% cash to buy into inverse ETF to have the hedging function. Okay, so as your portfolio decline in value, your inverse ETF will increase in value as the market decline. Right? So let's say the index delivers negative 1% return on that day, then your inverse ETF will deliver approximately 1% positive return for that day. On the contrary, if the index is delivering positive return, for example, it's up 2% for the day, likewise, the inverse ETF will deliver negative 2% for that day. So it is the other way around. All right. So if you are bearish about the market, you can consider inverse ETF. Whether you want to profit from a temporary market decline or you want to hedge your portfolio, you can consider inverse ETF. All right. So the keyword here again is inverse multiple of the one-day return. Okay. One-day return is very important. So this is an example of the daily inverse ETF, okay, versus FBM KLCI. So the one in orange is our benchmark index. So if you take a look at the benchmark index and the return by the daily negative 1x inverse ETF, you see that the performance is inverse. Okay, it's the other way around. All right, so this is the performance return. All right, so how are L&I ETF constructed? Now, unlike the conventional ETF, which are mainly constructed using full replication methodology. Okay, for example, if an ETF that tracks the FBMKSI if the index has about 13% weightage in public bank, the ETF will allocate 13% cash to buy into public bank. If the index have 12% weightage in Maybank, then the ETF will set aside 12% cash to buy into Maybank. All right. So this is a full replication. Okay. Whatever constituent stock that exists in the portfolio, so the ETF will mirror the weightage and the constituent stocks. But for leverage and inverse ETF, which we call a gear fund, okay, they they don't really hold the real equities. So what do? Is they use derivatives. They use derivative, be it swap, be it futures or options, to get the magnified exposure. All right. So, for instance, let's say the fund has about 1,000 ringgit net asset value. The leverage ETF will have will invest into or buy into derivative that could deliver 2,000 ringgit worth of net asset value. All right. So this is how leverage ETF is constructed. On the contrary, for inverse ETF, let's say the fund has an NAV of 1,000 ringgit. The inverse ETF will seek to buy into derivative, be it swap futures, okay, that can seek to return an inverse return of the index performance. So they'll get into futures options, okay, they can get them the return that is terbalik, okay, that's the other way around, okay, so that seek to get an inverse return from the benchmark index. So this is how leverage inverse ETF can be constructed using derivative instruments. So who are suitable to trade the leverage and inverse ETF? Now, leverage and inverse ETF are designed for sophisticated investors who understand the risk associated with the use of leverage. If you don't know what would be the risk of using leverage, then you stay away from L&I ETF. Okay, because leverage is a double-edged sword. It can help you if the market goes in the direction that you have exposure on. But it can also destroy your equity much faster if the market go against your direction. All right. So leverage is a double-edged sword. It is for investors who understand the consequences of seeking daily leverage investment results and who intend to actively monitor the portfolio. Okay. So so this is who is it designed for. So when I first started trading leverage inverse ETF, I was actually trading in the US market. At that time, Bursa Malaysia or Malaysia per se didn't even have leverage inverse ETF yet. So I was trading 3 times leverage ETF and 2 times inverse ETF, okay, in the US market. And actually, I was still naive back then, okay, like 9 years ago or 7, 8 years ago. I didn't really do much monitoring. And after like 2 weeks, I take a look at the return, then I suffer quite a big drawdown lah. So it's for people who really actively monitor and you trade on if possible daily basis, okay, not for like 2 weeks kind of holding. So it's not designed for investors who cannot tolerate substantial short-term loss. Okay, if you cannot tolerate substantial short-term loss and you have you will get anxiety because you lose a bit of quite a lot of money in a short period of time, then it's not suitable for you. It is not for people who are unfamiliar with the unique nature and performance characteristics of the funds that seek leverage daily investment results. And it's not for long-term investors who don't monitor the portfolio frequently. Okay. So back then, what I failed to notice is that the leverage funds seek the performance of 1-day return. Okay, I don't know it's 1-day return, so I hold it for a longer period. So I did not. I'm not aware of the compounding effect. I'm not aware of the daily rebalancing mechanism. So that's why I lose out on this kind of volatility that kicks in. All right, which I will share with you in a short while. So if you really need to spend time, if you want to trade leverage inverse ETF, you need to monitor the portfolio. Okay, not for long-term holding. So what are the common ways to get magnified exposure? Okay, there are a few ways where we can get a magnified exposure. Number 1 is to buy a margin or you do short selling. Number 2, short selling is for inverse. you buy warrants, be it a company warrants or structured warrants. Number 3, you buy and sell futures. Number 4, you buy leverage and inverse ETF. So these are a couple of ways where you can get magnified exposure. So what are the differences between choosing one from each other? If you buy on margin, is it possible to lose more than invested? Yes, right? Does it offer more than 3 times leverage? Yes. Okay. Can provide magnified exposure to an individual stock or security? Yes. Okay. You can get margin trading, okay, to trade one stock. Okay. May require investor to add to account to maintain margin levels. Yes, right? So these are all yes. If you buy warrants, is it possible to lose more than invested? No. If you put in 1,000 to buy warrant, the most you can lose is 1,000 ringgit. Can offer more than 3 times leverage? The answer is yes. You just look at the effective gearing of the warrants that you buy. Can provide magnified exposure to an individual stock or security? Yes. Okay. Structured warrants tracks individual stocks, or they can also track index. Okay. A company warrant, of course, just based on the mother share. Are you required to add to account to maintain margin levels for warrant? No. How about futures trading? Is it possible to lose more than invested? Yes. Okay. Can offer more than 3 times leverage? The answer is yes. Okay. Can provide magnified exposure to an individual stock or security? The answer is yes. If you trade, there are single stock futures. Okay. In Bursa Malaysia, there are single stock futures. So they can provide magnified exposure to individual stock. Okay. Number 4 is may require investor to add to the account to maintain margin level. The answer is yes. Okay. When you run out of maintenance margin, okay, your futures broker will call you to ask you to top up your cash. How about to buy leverage inverse ETF? Is it possible to lose more than invested? The answer is no. Okay. Whatever amount you buy, that's the most you can lose. Can offer more than 3 times leverage? At the moment is no. Okay. Because at the moment, the SC regulation is that 2 times leverage is what issuer are allowed to offer. And negative 1 times is what issue is allowed to offer for the inverse ETF. Negative 1 times, right? Can provide magnified exposure to individual stock or security? The answer is no. At the moment, they track the index. Okay. May require investors to add to account to maintain margin? The answer is no. There's no margin concept in the area of leverage and inverse ETF. So these are the differences between margin trading, warrant trading, futures trading, and also investing into leverage and inverse ETF. So you may pick one or each other if you want to get the leverage effect. All right. And these are differences. So you know what kind of leverage you want, and would you want to take more risks than you're supposed to? So here's a question. Let's say an index return, day 1 return 10%, day 2 return 10%. What would be the total aggregate return of the ETF? Okay, take a guess. Okay, can you please type in the chat box if you know? Can you have any guess? Okay, I see one of you here say 10%. Okay, so the real answer is 21%. Okay, so let me illustrate it for you. Okay, why is it 21%? Okay, so 10 plus 10 is not equal to 20. Okay, 10 plus 10 is equal to 21. Okay, so that's why this is the compound effect of the leverage ETF. So let's say the day 1 NAV is 1,000 ringgit. Okay, and in day 1, by the end of the day 1, you get 10% return. So what is the day 2 NAV at the beginning of the day is 1,100 ringgit. Okay, does it make sense? Yes, right? Then if day 2, they still deliver another 10% return. So you get 110 ringgit. So at the end of the day, the ending asset is 1,210 ringgit, correct? You get 1,100 plus 110, you get 1,210. So if you take 1,210, you divide by the day 1 beginning asset, you get 21% return. Okay, makes sense, right? So So you see, leverage and inverse ETF have 1 day investment objective. That's why I emphasize the word 1 day. Okay, 1 day is very important for you to remember. So for any period other than 1 day, the performance of a L&I ETF will not likely equal the benchmark return times the multiple stated in its 1 day investment objective due to compounding and daily rebalancing mechanism. Okay, so in other words, if you think that this is 2 times leverage return, right? Let's say this 2 times leverage. Um, Give me a minute. Let's say it's 2 times leverage return. So if the return 10% plus 10% will not be the same as 20%. Okay, because there's a compound effect. Okay, so this is compound and daily rebalancing. Every day the ETF will do rebalancing. So compounding can have its both positive and negative effects depending on the market movement. Okay, so we'll explore a few scenarios where how the market movement works, right? So these effects are magnified in leverage and inverse ETF. We have a few more scenarios to show you. Okay. So during trending periods, so let's take a look at this example. The NAV at the beginning is 1,000 ringgit. Day one return 10%. Okay. Day two return 10%. Okay. Similar like the example earlier, 1,210. Correct or not? So for 2 times return, you see it's 1,000 ringgit. Day one return is double. So it's plus 20%. So your portfolio, the 2 times leverage NAV will grow from 1,000 ringgit to 1,002 compared to the benchmark return. So day two, the benchmark return 10%, the leverage fund will deliver 20% because 2 times, right? So you get 240, right? So you get 200. So you get 1440. Okay. So this is 20% off 1,200. So you get 240. So you get 1440. So you take 1440, you divide by the NAV at the beginning period, you get 44% return. You take the benchmark return, 1,210 divided by the beginning value, NAV at the beginning period, you get 21% return. So you see that the return greater than 1 day is not the return plus the multiple. Okay. So which is what I said earlier. Okay. For any period other than 1 day, the performance of an L&I ETF will not likely equal the benchmark return times the multiple stated in its 1 day investment objective due to compounding and daily rebalancing mechanism. Okay, so it's not equal. If it is equal, it should be 42%, isn't it? Okay, but because it is not equal, because 20% of this value is 240. Okay, so you get 1440. So other than 1 day, the performance of the ETF is not equal the return plus the multiple times the multiple. All right. So you will notice that during trending periods, so this is trending period because for 2 consecutive days, the benchmark return delivers positive return. Right. So this is a uptrend market. Okay. During a uptrend market or trending period, compounding result in gear funds return greater than the benchmark return times the fund multiple. You see, the geared fund, the return is greater than the benchmark return times multiple, because benchmark return times 2 is equal to 42, right? But this is 44. So that's why it's greater than the benchmark return times the fund multiple. Notice that during a downtrend, on the other hand, notice that during a downtrend, the losses of the 2 times fund is less than 2 times the losses of the benchmark. Okay, let us take a look at this example. So the NAV at the beginning period is 1,000. You lose 10% after day one. So you lose $100. Okay, so you're down 900. Day two, again, you lose another 10%. Okay, you are down 90 bucks. Okay, so it becomes the NAV at the end of day two is 810. So how about the fund return? If you take a look at the 2 times leverage fund, the NAV at the beginning period is 1,000. Because you lose 10%, so you actually double your loss, right? It's negative 20%. So you lose 200 bucks. So you're down 800. So again, on day two, the benchmark return negative 10%. So the 2 times fund will deliver negative 20%. So negative 20% on 800 bucks is 160 bucks. Okay, so you're down by 160 bucks to about 640 bucks. So if you take 640 bucks divided by the beginning period NAV, you're down 36%. If you take 810 divided by the beginning period NAV of the benchmark return, you get negative 19%. So if this is truly 2 times return, you should be down negative 38%, shouldn't you? But because the investment objective is on 1 day, okay, so that's why they are compound effect. Okay, so on 1 day basis, so you actually down negative 36% instead of negative 38%. So in other words, during a downtrend, the losses of the leverage fund is less than the 2 times losses of the benchmark. Okay, so the losses shrink a little bit, compared to the losses times 2 times. All right, is it clear? Okay, next, let's talk about return during a volatile period. Okay, during a volatile period, let's say that the NAV at the beginning is 1,000 bucks, is up 10% after day one, so it's up to 1,100. And then, of course, the 2 times fund will up 2%, right? Up by 20%. Okay, so it's up by 200 bucks, so it becomes 1,002. On day two, the return is down 10%, the benchmark return. Okay, so it's down by 110. Okay, 10% of 1,100 is 110. So you take 1,100 minus 110, you get 990. Okay, so when the benchmark return is down 10%, the 2 times fund is down 20%. So 20% of 1,002, you're down 240. So your day two ending value is 960. So in other words, the 2 times leverage fund have a worse performance than the benchmark return during a volatile period. You see, day one is up, day two is down. So volatile, right? So the benchmark return after 2 days, it loses 1% value, but the leverage fund after 2 days, it loses 4% value. Okay, so that's how I lost a bit of my money back then. Okay, when I traded the leverage and inverse ETF without knowing this impact. Okay, so I paid my lesson. So now I'm sharing my lesson with you. So during volatile periods, compounding result in geared funds return lower than the benchmark return times the fund multiple. Okay. Another scenario. Okay. Beginning value 1,000 bucks. Okay. So but the first day, instead of up market, is a down market, right? So the market shrink by 10%. So the benchmark return, the benchmark NAV is down to 900 bucks. So the 2 times fund return will down by 20%, 800 bucks. Day two, the ballet, right? So instead of continuing a downtrend, the index go upwards. Okay, it appreciate by another 10%. So it gains 90 bucks. So it becomes 990 at the end of the day two. So 2 times return, because index is up 10%. The 2 times leverage fund is up by 20%. Okay, so 20% of 800 bucks is 160. So you're up to about 960 bucks. So by the end of the 2 day, the benchmark return is down 1%, but a 2 times leverage fund is down 4%. All right, you see that? So the investment return more than 1 day is not likely equal. Okay, not likely equal the multiple times the benchmark return. So the third scenario, okay, the third scenario is where the benchmark return on first day is down 10%. So 100 bucks is down to 900 bucks. So the leverage fund is down by 20%, so down to 800 bucks, right? Day two, the benchmark return is back to break even. It's up 11.11%, which is about 100 bucks. So it's back to the break even. So because it's up by 11.11%, so the leverage, 2 times leverage fund is up by 22.22%. Okay, 22.22% times the NAV of the leverage fund is 178 bucks. So it's up to about 978 bucks. So you see, even though the benchmark return go back to the same price, okay, let's say FBM KLCI drop to 1,000, from 1,004 drop to 1,350 and go back to 1,004, right? The leverage fund would lose money, okay? It's down 2.2%, okay? So it cannot get back to the break-even level, all right? So that's why it is important to closely monitor your position in gear funds, okay? The more volatile the benchmark, the larger the multiple of the benchmark performance is 6, and the longer you hold it, the more significant is the compound effect. So this is the point that we learned. So in a strong trend market, it's a strong trend market, you probably can hold a leverage ETF for a slightly longer period. Okay, because in a trending market, right, the benchmark return, the leverage return will be more than the benchmark return times the multiple. Just now we have seen, right? Okay, so in a strong trend market, you can hold it for a longer period. But if the market is very choppy, it is better that you do an intraday trading. Okay, you buy in the morning, you sell in the evening, or at most you hold for a couple more days. Okay, don't hold for too long, because if the market get volatile, it's very choppy, it goes sideways. Even though the benchmark return go back to break even, you will also lose money. All right. So after going through all the complexity of leverage inverse ETF, now I'm sure that you have gotten a better idea of how this mathematical compound effect works for you or against you, depending on the market condition. So what would be the eligibility to trade leverage inverse ETF on Bursa Malaysia? Okay, number one, the SC requirement is that you must be a sophisticated investor. Okay, you must be either or lah. Okay, there are 4 criteria. Either or, you fulfill one of these criteria, you can trade leverage inverse ETF. So the first criteria is sophisticated investor as defined by SC. Number 2, you have a margin account. Okay, if you are not a sophisticated investor, never mind. If you have a margin account, you can still trade L&I ETF. But if you're not a sophisticated investor and you don't have a margin account, can you still trade ETF? Yes, you fulfill the third criteria. Okay, you have executed at least 5 transactions in exchange traded derivatives, or you have, done more than 5 transactions in warrants within the preceding 12 months. For the past 12 months, you have done 5 transactions in futures or in warrants, right? Be it structured warrants, company warrants, right? Yes, you fulfill the criteria. Okay. If you have not a sophisticated investor, don't have a margin account, if you have never performed any trading in futures or warrants before, can you still trade? Yes, then you must fulfill the 4th criteria. Okay, you must utilize a performance simulator which simulates the trading in L&I ETF units and undergone an e-learning tutorials, okay, developed by the exchange for trading in L&I ETF units. So what you need to do is go to bursamarketplace.com, go to find the e-learning tutorial. Okay, You complete the tutorial. You do this simulator. After that, you will have a cert. You have a digital cert, right? The digital certificate. Then you tell your broker that you have this digital certificate. Then they will unlock the feature for you to trade L&I ETF. Right? So this is the fourth criteria. Okay, so you just need to fulfill one of them. If you fulfill one of them, you can trade leverage inverse ETF. So this is the protection mechanism lah. So to avoid the investor who are ignorant to trade L&I ETF without knowing all these effects. So how do we build a global ETF with global portfolio ETF? Okay, it is possible. Okay, you don't really have to leave Bursa Malaysia to gain exposure to the foreign markets. It is possible through locally listed ETF. Okay, you can get a global exposure without leaving the shore, right? So how can you do? It is possible if you buy into local ETF. So there are ETF that give you exposure to the US market, ETF that give you exposure to the Chinese market, ETF that give you exposure to other asset class. For example, bond, for example, gold, right? So this is just a sample portfolio. Okay, let's say you build 40% of the portfolio is earmarked for local equities. 10% is for American equities, 10% for Chinese equities, 10% for ASEAN equities, 10% for Asian REITs, 10% for bonds, and 10% for commodity. So for instance, this is how you want to build your portfolio. Okay. But you don't want to leave the Malaysian market. Why? Because estate planning, you don't want to exchange foreign currency and the spread and so on. So you use the local ETF that give you exposure to the foreign market. Yes, it is possible. All right. So for instance, you want to buy, you don't have time. You want to buy into ETF that give you exposure to the local market. You can buy into this. For instance, this is FBM KLCI ETF. All right. So, but most probably, if you are an investor, okay, like retail investor, we typically do direct investing. Okay, by buying local stocks, we usually do direct investing. We buy stock A, stock B, stock C, stock D, right? So we accumulate stocks. Then you don't have to buy ETF. Okay, so the local stock you can buy yourself. Okay, but if you don't want to do direct investing, you want to do indirect investing, of course, then you can buy into pass your money to fund manager lah. Okay, so you can buy into a LCI ETF, for instance. This is the performance of 5 years. It's down 14.72%. Compound annual growth rate is down 3.2% a year lah. Huh? Now, if you want to buy US equities, of course, this is an example. You can buy into my ETF Dow Jones US Titans 50. So this is the performance for the past 5 years. It's up 119%. Okay, this is, in my opinion, the best performance, the ETF that deliver the best performance. Okay, so compound annual growth rate is 16.97%. As you know, American market is reaching all-time high right now. Okay, so they have broken the multi-year high. So now they are very approaching the all-time high at the moment. So of course, the ETF that tracks the US market, in this case, they tracks the 50 largest Sharia compliant stocks in America, also perform well. Okay. Now, Chinese market, for instance, if you want to get exposure to Chinese market, this is an example. You can buy into a China ETF. This is issued by this is Trade Plus S&P New China Tracker, which tracks the Chinese economy. Sorry, not the old Chinese economy, but the new Chinese economy. Okay, for instance, mainly are technology stocks. Okay, so not many, no bank stock if I'm not mistaken, but mainly no technology stock. But of course, because the technology clamped down, China property market slow down. So when the Chinese market have weakness, the ETF that tracks the Chinese benchmark will also underperform as well. So if you feel that this is Chinese market is value investing at the moment, then of course you can get into this ETF. All right. So the ROI since inception is down 15.6%. So for ASEAN equities, okay, you can buy into this ETF, my ETF MSCI Southeast Asia Islamic Dividend. Okay, that give you exposure to a few countries like Singapore, I think Thailand or Indonesia, if I'm not mistaken. Okay, go to their prospectus to check which kind of countries they buy. So this is the performance so far. 5 years return is down 4%, but this does not include dividend return because this is this dividend fund, right? This fund seeks to buy stocks that pays high dividend yield, right? So this is just merely from a capital appreciation or depreciation, right? Plus the dividend return, this fund will result in a positive value. Of course, if you want to buy into properties, okay, you want to get exposure into Asian REITs, right? Ex-Japan. This is another fund that you can consider. It's Trade Plus MSCI Asia Ex-Japan REITs Tracker. I went to the fund's website and noticed that many of the constituent stocks are the REITs that are listed in SGX. Okay, so you buy into this Trade Plus MSCI Asia. You don't have to go to SGX to buy their REITs, right? So this is an example. Okay, so you can buy into AXJ dash REIT ETF to get exposure to the property markets in Asia. So ROI since inception is down 26.47%, slightly due to the hawkish environment. Okay, because in the hawkish environment, when interest rate is very high, a lot of funds have they will park their funds in FD. They have a lot more alternative during an environment where interest rate is very high. REIT typically loses their appeal, huh? So this does not include dividend return. Of course, if you include dividend return, then it should be more or less close to break even, I guess. So of course, you can also buy bond, if you want to buy Malaysian government securities, but you don't have so much cash to buy from the secondary market through your bank issuance, okay, through the bank offering, then you can go to the buy into the ETF that tracks, that buys the bond, right? So this is ABF Malaysia Bond Index Fund, is issued by M Funds Management. All right, if I'm not mistaken, yes, by M Funds Management. So ROI return for the past 5 years is 2.7%, and it does not include dividend return. If you include dividend return, of course, it will be much higher. So last but not least, you want to get exposure into gold, you can consider this Trade Plus Sharia Gold Tracker. Okay, so this is ETF that buys into physical gold. It's backed by physical gold. Okay, so 5 years dividend, 5-year return on investment is 77.21%. Okay, compound annual growth is 12.16%. So issued by Aham Asset Management. All right. So this is some ETF that you can consider. Of course, there are also other ETF that you can consider to help you to build a global portfolio. All right. So before I conclude, let's just quickly sum up why should you consider ETF? Because 99% of the actively managed US equity funds underperform. In America, the passive funds always outperform the active fund in most cases. Okay, there's a strong growth in the global ETF and exchange traded products market. Okay, for the past more than 10 years. Okay, since 2006 until end of 2022, the ETF market has been growing by leaps and bounds. And Warren Buffett is also an ambassador for ETF, right? Warren Buffett said that he will leave behind 90% of whatever money he hasn't already given away, not in Berkshire Hathaway shares, but the Vanguard S&P 500 fund that ordinary investors are already buying up so quickly. So ringing endorsement don't come any better than that. Of course, last but not least, the entry fee in Malaysia fund management industry are among the highest in the world. Okay, you want to save money in terms of reducing your initial sales charge, you can consider to get diversified exposure through passively managed fund like exchange traded funds. So I have concluded the session to share with you what are ETF, how do you evaluate ETF, debunk the myth of liquidity myth of ETF. I also explore the tools of leverage ETF and inverse ETF, how you can protect your portfolio. And last but not least, we talk about how do you build your global portfolio with locally listed ETF so you can get global exposure without leaving the Malaysian shore, right? So if any question to ask me, you can type your question in the Q&A box. Okay, I've seen the first question on my panel is asked by Bernard. Why is there no sectorial ETF in Bursa Malaysia? I think the biggest challenge in ETF is that there's not enough traction. That's why as the exchange, they are doing educational initiative here to let retail investors know that ETF exists in Bursa Malaysia and what are the characteristics of ETF. So if there are enough interest, if the AUM grows within the ETF space, in Malaysia, most retail investors buy unit trusts. Okay, ETF, the traction for ETF is not as great compared to unit trust. So if the AUM grows, then the issuer will be more incentivized to come out with the ETF that tracks the sectoral ETF, right? We have like 13 sectors here in Bursa Malaysia, and the issuer will come with ETF that tracks the telco sector, the technology sector, the property sector, and so on. So first, the interest and the traction for ETFs must grow first. Okay, when the ETF interest grow, you will see that the passive, the fund management fee will drop a bit. Okay, as the AUM grow, the fund management fee will likely to drop. Then there will be more offerings. Okay, if the interest is not there, then why the issuer want to structure the ETF to sell it to you, right? So that's my opinion. Okay, so all of you here, if you're here, if you want to do passive investing, indirect passive investing, then ETF will be your go-to option. Is there a compounding effect for normal ETF, just buy and hold? The answer is no. If you are just buying a conventional ETF, yes, that's for buy and hold. The compound effect will only works if it is on a geared fund, which is a leverage and inverse ETF of multiple returns. Okay, so if you just buy passively managed fund, conventional ETF, there's no compound effect that you need to be aware of. The next question asked by Maslan Yusuf: why did you classify REIT separately and not part of equity? Yes, REIT is part of the equity. Okay, if I put it correctly, I think it's part of equity. Okay, if you go to my list, right, is under equity lah. Hang on, yeah. There's just too many slides. Okay. Yes, I classify it under equity. Okay, I hope that clarifies the misunderstanding. So it's under equity. Okay. So the difference between buying a REIT and an ETF that tracks the REIT is that if you buy a REIT, you only buy you only get exposure to the properties that the REIT own. If you buy an ETF that tracks the REIT, you instantly open up the REIT to a lot more market, right? For example, if you just buy IGB REIT, then your exposure is to Mid Valley and the Gardens Mall. Okay, but you buy the Asian ETF, okay, that tracks the REITs that track the ETF that track the Asian REITs, then you suddenly have exposure to about hundreds of thousands of real estate in Asia. Okay, the index tracking ETF, does it follow a certain mathematical formula to track the index? To answer this question, this question asked by Kok Long. Okay, does this follow a certain mathematical formula to track the index? It depends on the investment objective, okay, and how the ETF is constructed. If for ETF that is full replication, that means whatever stocks that they have as a constituent stocks, they will buy it. They will buy using cash with you buy using cash to their specific weightage, then that's what it is. It is because it replicates the exact formula, right? So there's no mathematical formula. But for synthetic replication, that's when because some market some market is not easy for you to have access to. For example, China market, right? It's not easy to have access to. So sometimes they have to use certain kind of instruments to replicate the index, right? So that one, the fund manager will have to play a slightly more active role to ensure that the derivative or the instrument that they use will deliver the performance that mirrors the benchmark return. Okay, if the performance divert or differs too much from the benchmark return, then they will have to make adjustment to the derivative or the instruments that they buy in order to track the index. Okay, so hope I answer your question. Okay, so it of course depends on the index and it depends on the replication methodology. Okay, let me go back to the Q&A slide. All right. Okay, we have overrun the session for a bit. It was supposed to be an hour, but then I think I just went overboard for a little bit. And for those of you who stay on, thank you so much. So I just see a couple more. Hang on, yeah. All right, a couple more on chat, right? Is the brokerage fee for ETFs similar as equities? The answer is yes. Okay, it should be similar. Most of the time, it should be similar. All right. Okay, great. Looks like I've answered all questions. So hope that the session today has helped you to gain, understanding, increase your understanding on the exchange traded funds, and how you can use leverage fund to get magnified exposure, and how do you use inverse ETF to get to hedge your portfolio. All right. So with that, I want to thank all of you here for spending your time with us today. So this is Choo, and thank you so much for your time.